Today we're going to talk about a new tax torpedo created by the recently passed One Big Beautiful Bill. This tax torpedo results in a marginal tax rate significantly higher than the highest federal tax bracket of 37%. So who does this affect? First, you must itemize your deductions and have state and local taxes above $10,000 up to $40,000. If you file single or married filing joint, the phase out of the SALT deduction starts with modified adjusted gross income above $500,000. For married filing separately, it starts at income above $250,000. Each dollar that you earn above that threshold results in a 30% reduction in your SALT deduction. Now let me show you what this looks like. This is a couple married filing joint with $500,000 of taxable income. They are itemizing and they have over $40,000 of state and local taxes. Now at the $500,000 mark, they're in the 32% bracket. As you can see here, shout out to Holistaplan, 0% tax bracket, 10%, 12, 22, 24, those are all filled up and they're in the 32% tax bracket. Now the next dollar that they make not only is taxed at 32%, it actually reduces their itemized deduction because that SALT tax deduction ends up getting phased out because of the income that they've earned. So for the next $80,000, this is the highest marginal federal tax bracket that you'll see. If I zoom out, right here, this is that area where it bumps you up to 41.6% for about $40,000 and then 45.5% for the next $40,000. And what that means is this $80,000 of income that you make, about $35,000 of that $80,000 goes straight to the federal government. You get to keep $45,000, but then you probably have state taxes on top of that as well. Now this shows a very dreadful tax situation because they just made it through the SALT Deduction Tax Torpedo. That last $80,000 was taxed at the highest federal marginal rate. Now, I don't know your specific tax situation, and you should consult with professionals for your own planning purposes, but here are some ways, if you happen to be in this tax torpedo, that you can reduce your taxable income. Number one, maximizing your pre-tax contributions to retirement accounts, like 401k, SEP IRA, etc. Since this income is being taxed at the highest possible marginal tax rate, pre-tax deductions are good because you'll likely withdraw at a lower marginal rate in the future. Number two, maximize your HSA contributions. If eligible, this is a no-brainer to me. You can put $1 in an HSA account that could grow tax-free, or pay nearly half of that in taxes and put the remainder in your pocket. If you're eligible to contribute to an HSA at this marginal rate, it's likely worth doing so. Number three, you can increase your charitable giving or bunch charitable giving into 1 year, where this is going to affect you. This will increase your itemized deductions. Look into a donor advised fund in order to do this. Number four, tax loss harvesting. If you have an advisor worth their salt, no pun intended, they should be doing this for you. You're limited to deducting only $3,000 of net losses a year, but it can help to offset other capital gains that you may have. And number five, I think this is the most overlooked option. You should evaluate your asset location strategy. Now this is different than your asset allocation. Your allocation is the percentage of your portfolio, say in fixed income versus equities. But your asset location is what account type is holding what investments. If you have a large taxable brokerage account, you can strategically hold low income producing assets in that account and defer interest, dividends, etc. in your pre-tax bucket. Don't confuse low income with low performance. You are likely to have a portion of your portfolio in growth equities that do not pay high dividends but are still expected to appreciate significantly. This also helps because you can likely take advantage of long-term capital gain rates in the future when you sell, versus paying ordinary income rates on that growth that would otherwise occur in your pre-tax account. Alright, I hope you found this video helpful. If you would like a more in-depth look at your personal situation, please reach out. I'd be happy to do so. I'll put my contact information in the description. And check out a prior video by clicking here for a condensed version of my interview with Austin Simpkins on the Accelerated Financial Advisor path. And as always, money is a tool, knowledge is freedom, and planning is power. I hope you have a great rest of your day.